Hello everyone, and welcome to today's webinar on Business Credit Scores Decoded. I'd like to thank everybody for taking the time to attend this webinar today. If you've ever wanted to know more about business credit scores, today is your day. Today we're going to dive into business credit scores. We're going to decode them. We're going to go through. We're going to take a look at the three business credit reporting agencies, take a look at all of their individual score models. How their score models work. We're going to talk about how a business can establish scores and use that to get credit. We're even going to take a look at a real live process of a client being able to build business credit scores for their business and use those business credit scores to get money. So we got a lot of stuff to go over. Now, I will tell you that if you've never been on one of my webinars before, I will give you a heads up. I'm a fast talker. I get excited about things. I'm excited about business credit, and when I get excited, I kind of get on a roll and go at a pretty rapid pace. So we're going to get started with business credit scores. We're going to dive right in and get into kind of the fundamentals of what business credit scores are. If you're not familiar with business credit, what business credit scores are is these are scores that are for a business, okay? So they're in the business name. With business credit, the business builds its own credit profile and score. Okay, so it's not like personal credit where you're dealing with a FICO score and a personal credit report. This is actually talking about a business credit report and a business credit score. Now, once a business has an established credit profile and score, that business is then able to start actually qualifying for credit. Now, business credit scores access or reflect a business's ability to pay, not the business owners. So since the business itself qualifies for the credit, in some cases there's no personal credit check required from the business owners whatsoever. Now, the business can use those credit scores once built to qualify for credit cards, like revolving credit cards like Staples, Lowe's, Sam's Club, Costco, Walmart, MasterCard, Visa, American Express. The business can also qualify for credit lines, even loans, once those business credit scores are actually built. Now, a business credit score, by definition, is a mathematical model that's used to depict a business's risk of going 90 days late on an account within the next 12 months. Now, this is important because a lot of you on the call are familiar with personal credit scores. And a consumer credit score is a mathematical model that's used to depict the consumer's risk of going 90 days late also, but it's within 24 months. So that's one of the biggest differences with business versus personal credit scores. It's one of the main differences, although there are a lot, is business credit scores basically gauge the risk of somebody going late within the next 12 months, whereas consumer scores gauge the risk of somebody going late within the next 24 months. A business credit score reflects the business's likelihood of defaulting on an obligation, not the business owner's. So the business credit score is based on how the business obligations are being paid, not how the business owner is paying their personal obligations. So let me introduce you to the business credit reporting agencies. Now, we're not going to spend a lot of time on these three agencies. We'll do that in a whole nother webinar because we could go on and on about them. But what I am going to do is give you a brief kind of history of the business credit reporting agency and then start diving into their individual credit scores. And I mean scores is plural because a lot of them offer multiple different scoring models. Now, Dun & Bradstreet is by far, the biggest and major business credit reporting agency. They were created in 1841. They're known as D&B. So you'll hear this a lot. If you hear somebody refer to a D&B, they're referring to Dun & Bradstreet. And they also hold the largest supply of worldwide business information with over 206 million records. That's how many businesses they have on file that they track, is over $206 million today, or 206 million records to date. Obtaining a DUNS number is the first step towards getting business credit scores with Dun & Bradstreet. The DUNS number is the Data Universal Numbering System, or DUNS, and it's a business identifier code provided by D&B, provided by Dun & Bradstreet. Now, this identifier was actually developed way back in 1963 to support D&B's credit reporting practices. Now, the DUNS number is a 9-digit number issued by Dun & Bradstreet, and it's assigned to each business location in the D&B database, each having a unique, separate, and distinct operation for that purpose. every business must first have a DUNS number before D&B will assign a Paydex business credit score. This is important. D&B is the only one that does this. They're the only one that have like a pre-step to getting their business credit score, and their pre-step is their DUNS number. You cannot get a Paydex score with them without it. It is the first step in securing a Paydex score with D&B is having that DUNS number. Now, the DUNS number is the preferred method worldwide of identifying businesses. Okay, so unlike national employment identification numbers, which most of us are familiar with, I mean, most people are familiar with EINs for your business, but a DUNS number may be issued to any business in the world. That's one of the biggest differences. Okay, as an EIN is kind of our government's way of knowing your business, whereas a DUNS number is a worldwide identifier for your business. And it's issued by many foreign governments, including the U.S. and Australia, the European Commission, even the United Nations. So let me give you an example here. If you're a contractor and you want to go do work with the UN or with the U.S. government, they require a DUNS number. They require you have a DUNS number to even get contracts and do work with those kind of governments. Even the European Commission is actually that way. All in all, there's more than 50 global industry and trade associations that recognize, recommend, or require the actual DUNS number. Now, Dun & Bradstreet's score. The main credit score used in the business world is known as a Paydex score, provided by Dun & Bradstreet. You've probably heard of this before. So you've probably heard somebody mention to you before they have a good Paydex or an 80 Paydex or a Paydex with D&B. Paydex is D&B's credit score. Now, from D&B's actual site, in quotations, their definition is the D&B Paydex score is D&B's unique dollar-weighted numerical indicator of how a firm paid its bills over the last year and is based on trade experiences reported to D&B by various vendors. Okay, so that is actually from their actual site. It gives you an idea of their exact definition of what their score is. Now, I'm going to stop here because I've actually had some clients ask, and they say, well, does that mean that they only look at data over the last 12 months while calculating the score? The answer to that is no. What they're doing is they're calculating the risk of somebody defaulting over a 12-month period, but they will take into account all the information that is on that actual report. And in a minute, we're going to go into what they actually do show you on their reports. Now, the Paydex score ranges from 0 to 100, with 100 being the highest score a business can obtain. A score of 80 or higher is considered good or healthy credit. It's kind of the equivalent of like 700 in the consumer world, right? You can get as high as 850, but if you have a 700 consumer score, that's pretty good credit. The same thing here. An 80 reflects good credit or a good, healthy business credit profile. Now, a business can obtain a good business Paydex credit score by ensuring payments are made promptly to suppliers and vendors. So let's take a look at personal credit scoring because I'm about to give you a direct comparison of Paydex versus personal credit score. And as most of you know on the phone or on the call today or on the webinar today, the personal consumer scores are broken down into 5 factors: payment history, utilization, length of credit history, accumulation, and new credit mix. Okay, there's 5 components that make up the actual score itself. And it's a little bit tougher, more confusing, much harder to build a good personal score because it's tough to control things like credit mix, length of credit history. Some of these factors are very tough to control, so it's hard for people to jump up and have good scores very quickly. Now, business credit scores, especially with D&B, are very different because they're based on the business's ability to pay its bills on time. So the number literally reflects exactly how that business pays its bills. That's exactly what the number actually reflects. So the business credit score, the Paydex score, reflects how early or late a business pays its bills. For example, if they pay their bills promptly or on time, the business will have an 80 score. If they actually paid their bills early, they'd have a 100 score. If they paid their bills 90 days late, they'd have a 30 score, and so on and so on. Now, see, this is very interesting because remember, the consumer scores are made up of 5 factors. Business credit scores with Paydex and with D&B are only based on one thing: how's the business pay its bills? If it pays its bills, 3 weeks or a week early, it gets this score. If it pays it 3 weeks late, it gets this score. That number literally reflects the time period that business pays its bills. Much different than consumer scores. Now, a business will need a Paydex score of 80 to obtain the most favorable financing. As we just saw, 80 literally means that they're paying their bills on time. So they either need to pay their bills on time or early to be able to obtain the most favorable financing. And this score simply reflects the business's ability to pay its bills on time. So to obtain a Paydex score, a business will need at least about 5 trade accounts reporting to their profile. This isn't exactly accurate. You could really actually get only 2 or 3 accounts and probably still get a Paydex score. But to really start the beginning of a solid credit profile and to really build a good, decent, deep Paydex score to start, you're going to want to have about 5 accounts. And it can take as long as 90 days for those trades to report and score to be established. Okay, D&B will quote that it takes up to 3 reporting cycles, which is basically about 90 days. Although you could really, and we've seen Paydex scores established as soon as 30 days, 60 days. So 90 days is usually as long as it takes for somebody to be able to establish Paydex score once trade lines are reported on their credit report. And the business credit score itself is calculated by using as many as 875 payments. Okay, this is important because, again, as I just said, they don't just look at what you did in the last 12 months. They're looking at all the data on the report. Their score model can actually use up to 875 total accounts in their algorithm to be able to calculate what the actual Paydex score truly is. Now, it's important for a business owner to have accounts report favorable payment history. So if bills are paid on time, the business credit score will be positive. But if payments are paid late, then the Paydex business credit scores will obviously drop. How low the scores drop, as you just saw, depends on how late the bill is paid. The Paydex score will adjust accordingly to how early or late the bills are paid. Okay, so if somebody has an 80 Paydex and then they start reporting late, then that score is going to take into account the bills that they paid on time and the bills that they calculate or actually were paid late. You know, another important aspect of the Paydex is that with most business owners aren't aware of is Paydex's weighted average score. So this score gives more weight to the trade accounts that report higher amounts of credit extended and less weight to trade accounts that are reporting lower dollar amounts of credit. Okay, so look at this. With this weighted average, they're telling you they're giving more credit to accounts with higher limits than accounts with lower limits. So if a business owner is having any trouble meeting all their credit payback eligibility or obligations, basically if the business owner is struggling to pay the bill, then in other words, they know that they're going to have to pay a bill late, then it's important for that business owner to be sure to pay the largest dollar creditors first because of that weighted average. This way their reporting, which carries more weight in the business Paydex score, will remain positive. Okay, so D&B Reports. Dun & Bradstreet lists on their reports details on payments the business has made for each individual account, including their full payment record, their upper credit limit, how much they currently owe on each account, how much is past due, what the terms of the account are, and when the account was reported and last updated. Now keep in mind, I'm talking about what is on the reports, not what's calculated into the score. I just threw this in because I wanted you to get an idea, if you've never seen one, of what kind of data, what kind of information D&B actually shares on their actual credit reports. Extra information D&B provides includes detailed financial information such as current assets, liabilities, working capital, net worth, sales, new profit and loss, and more. Just like anything else, you know, when you go to apply for something in the business world, you supply a lot of this data on the application. And if you've supplied a lot of that data on the application, then it's typically going to show up on that D&B report. D&B reports also list payment details for each account. They also add detailed commentary to the report indicating payment patterns. Okay, D&B's Supplier Evaluation Risk Rating, SER. So even if you are familiar with Paydex, I would probably guess less than 1% of the people on this webinar today have heard of the SER. Okay, this is D&B's Supplier Evaluation Risk Rating. This isn't something that you're going to see a lot, but I still wanted to touch base on it with you so you could at least see the other score models that these agencies provide. Now, this rating predicts the likelihood that a company will file for bankruptcy and cease operations within the next 12 months. This score ranges from 1 to 9, with 1 being the lowest risk and 9 being the highest risk. In a lot of cases, you'll see this SER score on the business credit report from D&B along with the Paydex score. Okay, another score is the D&B Supplier Stability Indicator, or the SSI. And this model predicts the likelihood that a supplier will encounter a large and significant financial or operational stress over the next 90 days. And this score ranges from 0 to 10, with 0 being the lowest risk and 10 being the highest risk. So let's move on to Experian. Now, please note, I'm moving kind of in order here. Well, not kind of, exactly in order. D&B by far is the biggest. They're the big dog in the business credit world. Experian is second. Equifax is an afterthought. They're really not big in the business credit world at all. So Experian really is the second most popular business credit reporting agency. Now, Experian actually stemmed from TRW, which was founded all the way back in 1901. Okay, that's interesting. They're actually the oldest credit bureau. A lot of people don't know that. They provide business credit evaluations for over 27 million small businesses and corporations. This is the second biggest player. They hold 27 million business records compared with Dun & Bradstreet's 206 million records. So it gives you an idea of the scale of how big D&B is in the business credit world compared to the other less sized companies with Experian and Equifax. And Experian's headquarters is in Dublin, Ireland. Okay, again, most people don't know that. So I just wanted to throw that on the slide because a lot of people, of course, think that Experian is housed in the United States because they deal with United States data. They obviously have offices here, but their actual headquarters is in Dublin, Ireland. So Experian's Intelliscore. Experian's most recent score system is known as Intelliscore Plus. Now, you'll commonly won't hear the plus. When you're hearing people talk about Experian score, you'll commonly hear it referred to as Intelliscore, okay, which they boast is the next level in credit scoring. This method was released in 2008. Again, I'm talking about the Intelliscore Plus. Intelliscore's been around for a while. It was their Plus model, their upgraded version that was just released in 2008. Intelliscore Plus takes into account hundreds of variables to offer a business credit score between 0 to 100, with 100 being the highest. Now, Intelliscore Plus is advertised as a highly predictive score that provides a very detailed and accurate reflection of a business's risk. Intelliscore actually predicts a business's risk of going seriously delinquent or over 91 days late or having a major financial issue such as a bankruptcy within the next 12 months. Okay, so pretty common here, same at this point, same as D&B. They're looking fundamentally at a business's risk of going 90 days late in the next 12 months, okay? So that part of the score is similar to D&B's Paydex Score. The 0 to 100, this is where things get different. The 0 to 100 is a percentile score that reflects the percentage of businesses that score higher or lower than the specific business being looked at. Okay, let me give you an example. So for example, if the business has a score of 20, this means that company scores better than 19% of other businesses. This also means that 80% of other businesses score higher than that business. Okay, so you with me? The score basically is if they have a 20, that means 80% of other businesses have better scores than they do. And that also means about 19% have less score than they do. So that's actually what the score reflects, which is very different than Paydex. Intelliscore is already being widely used. Many of the largest financial institutions worldwide use it, along with over half of the top 25 P&C insurers and most major telecommunications and utility firms. I'm telling you this because I want you to get an idea of who's using Intelliscore. Okay, industry leaders in transportation, manufacturing, technology have also been known to use Intelliscore as their primary risk indicating model. Now, the new Intelliscore Plus has over 800 aggregates or factors that affect the credit score. Some are assessed on the more than 7.2 million businesses in Experian's actual database that they score. Remember, they've got a larger database, but they only have scores issued for a smaller percentage of those actual companies. Experian first takes a business and looks at data segments such as firmographics, public records, collections, and trade information, and then places each business in one of the three different models. The first is their commercial model for small, medium, and large businesses. The second is their blended owner model, where the commercial data is then linked with the owner's information. Okay, we all know Experian is in the consumer field too, right? I mean, I know, I'm pretty sure everybody on the call knows that. So they the second option is a blended model where it does take into account the personal credit of the business owner. That's important to know that Experian does offer that because some creditors will pull that. Thirdly, there's the Intelliscore Plus or their percentile score. So there's actually 3 different versions here a client can get. The Intelliscore Plus is what we've been talking about, but their blended owner model is also available and a commercial model is also available through Experian. So Experian's Intelliscore breakdown. I'm going to kind of go through this with you based on percentages of what make up that score. Just like we looked at the consumer breakdown. We just looked at the 5 factors that affect consumer scores and their breakdown. We're going to do the same thing with Experian's Intelliscore here. Okay, just like FICO, it has multiple facets to the entire score makeup. The score is still based on the payment history of the business, but many other factors tie into the percentages of the overall score. So the historical behavior or payment history accounts for 5 to 10% of the total score. Okay, current payment status, trade balances, and percent of accounts delinquent accounts for 50 to 60% of the score makeup. Okay, the business's credit utilization affects 10 to 15% of the total score. This has to do with the amount of credit that's been extended to the business in relation to the balances they currently have on those accounts. Okay, the company profile, age of business, industry risk, and size of business assessed by number of employees accounts for 5 to 10% of a total score. And 10 to 15% of the total score is determined based on the derogatory items, collections, liens, judgments, and bankruptcy that business actually has. Now, when Experian is assigning a business a credit score, they take many factors into account. They refer to those factors as predictive data and use this data to better determine a business's lending risk. So multiple factors affect the score, including average balances on accounts, all those things we just talked about. Okay, so now let's jump to Equifax. Equifax is the oldest and largest credit bureau in existence today. Actually, I think they were around before Experian, so I think I misspoke when I said that. That's right. They were in 1898, and Experian was actually, or TRW was created in 1901. So Experian was 1901, and Equifax is the oldest in 1898, 70 years before the creation of TransUnion. It's kind of crazy if you think about it, right? I mean, Equifax was around 70 years before TransUnion was. Equifax was gathering details about people, including their marital troubles, jobs, school history, childhood, sex life, political activities, and more. And in response, the U.S. Congress met in 1971. It enacted the Fair Credit Reporting Act. You know, a lot of people don't know that history. They don't know that, you know, what happened. Equifax back in the day, they used to reward their employees for getting the most dirty information. I mean, it was sick. They would call your neighbor, find out you were getting a divorce, then they would call your other neighbors and sell that information to them. That's what they were doing. It was crazy. They had no level of evaluating whether the data was true or not true. It was just they would gather data and sell it to anybody that would buy it. Now, what happened is in 1971, when the Fair Credit Reporting Act came out, they started going digital. Okay, Equifax was moving into a digital age where their records were going to be computerized, and that's one of the reasons Congress stepped in 1971 and came up with the Fair Credit Reporting Act, because they knew Equifax was doing things that they weren't supposed to be doing, and they knew the minute it went electronic, it was going to start happening on a mass scale. So it was kind of Equifax's, you know, the things they were doing, their business practices that really led to the Fair Credit Reporting Act, which a lot of people don't know. Equifax's credit risk score. Equifax's main business credit score is the credit risk score. This score was created to predict the probability of a business customer becoming seriously delinquent on supplier accounts or bankrupt within the 12-month period, same as the other two. Credit scores range from 1 to 100, with a lower score indicating a higher risk of serious delinquency, exactly the same as the other two. By definition, the score predicts the likelihood of a business incurring 90 days delinquent or charge off in the next 12 months, exactly the same as the other two. Scores of 90 and above express that obligations are being paid as agreed. A little bit different than the other two. Scores from 80 to 89 indicate payments are being made 1 to 30 days late. Scores of 60 to 79 represent payments being paid 31 to 60 days late. Scores between 40 and 59 indicate somebody's paying 61 to 90 days late. Scores between 20 to 39 mean the obligations are being paid 91 to 120 days late. Scores between 1 and 19 mean the obligations are being paid 120 days past due. Okay, this is very different than what you've seen on both the other two bureaus. Okay, so Equifax also provides a business credit score for suppliers known as their Small Business Credit Risk Score for suppliers. This model is designed to help credit grantors improve their risk assessment and reduce delinquency rates while helping to improve profitability. Okay, and the score utilizes unique bank loans, lease information, credit card data, telco and utility, credit history, supplier information, public records, firmographics data from their own Equifax commercial database. And the Small Business Credit Risk Score for suppliers ranges from 101 to 816. Much like with D&B, you could pull an Equifax report and sometimes get multiple of these scores on there. So you might see one report and see multiple scores listed, including this risk score for suppliers, which ranges from 101 to 816. So Equifax offers a business failure risk score with many reports also, and this score predicts the likelihood that the business will fail or file bankruptcy within the next 12 months. Guys, you're seeing this common. This is a pattern we're seeing, right? These business credit reporting agencies kind of all offer this secondary score, which is used to depict if the business is probably going to go bankrupt or not. Okay, so that's common with Equifax. You also saw that mentioned with D&B. This model helps identify businesses that pose a great risk of failure to the suppliers and credit grantors so they can take appropriate action. So Paydex, and now we're going to kind of get into a score summary. What we're going to do now is I want to go ahead and summarize what we've talked about here with these business credit scores. Then we're going to dive into the funding suite. I'm actually going to walk through and show you the process of building business credit, the process of using business credit and of getting funding, and also of obtaining business credit scores, building business credit scores, and using those credit scores to get cash funding. So Paydex, Intelliscore, and the Small Business Risk Score are the most popular business credit scores. We dove into a lot. We talked about, 9, 10 different models here today. But Paydex, Intelliscore, Paydex from D&B, Intelliscore from Experian, Small Business Risk Score from Equifax, these are the three most common of the business credit scores. And a positive score can be obtained in as little as 60 to 90 days with all three business credit reporting agencies. As I discussed earlier, I've seen it done as little as 30 days, but I always like to, set the expectation longer out than it really is. So I'm going to say in this slide that it could take 60 to 90 days, maybe even sooner, to establish business credit scores. And pretty much with all three, paying business bills as agreed will net a positive credit score at all three reporting agencies. Even though Experian's model is a little bit off, it's a little bit different than the other two, all three are fundamentally the same in the fact that if the business is paying its bills as agreed, then it's typically going to have a good business credit score. And ladies and gentlemen, this is why business credit is so powerful, because it takes years of well-disciplined borrowing for a person to establish a good, positive, strong, deep consumer credit score. Somebody could do the same thing in the business world within months. Somebody could have a deep, good credit score where they're starting to get high-end credit cards, credit lines in 6 months with business credit, and that couldn't happen in the consumer world. Somebody couldn't start from zero and start getting $10,000 credit cards in 6 months in the consumer world. But in the business world, they absolutely can. And in large part, due to this last statement, because business credit scores are kind of based on common sense. Does the business pay its bills on time? Yes, it has good scores. Okay, a consumer can pay their scores on time, but have be maxed out on their utilization ratios, have the improper credit mix, have a lot of inquiries, and still have low scores. But in the business world, the business pays its bills on time, it's going to have good scores. So this is one of the big benefits of business credit and why it's so much easier to establish a good business credit score and profile than it definitely is in the consumer world.